do you collaborate or not collaborate? In this case, this time of year, your best is to have smaller trades. So you're saying like smaller day trading is typically what you like to do around the market open. That's perfect.
Yeah,
This time of year, that's perfect.
yeah, yeah. But it's always nice to have some expectation and a directional bias. So in terms of the dollar on my chart here, starting with the weekly chart, right? We've been in this bullish trend, which really took off uh, March last year, so a little bit over a year ago. That accelerated. Um, that was part of the dollar smile theory. If we go all the way back to the monthly chart, when anything out there, whether good or bad news, seemed to benefit the dollar. Do you see that going forward? I mean, we've come away from those highs on the monthly chart.
Yeah.
That is a technical area of resistance all the way up there. I'm guessing everyone's seeing that. My chart is being shared, I think.
Yeah.
So
How far out are you going? You're going all the way back to 2007? Okay, I got you.
yeah,
Yeah.
this is all the way back to 2000. So we've come down from there pretty steeply,
Yep.
and
Sure.
the notion is that the Fed was stepping off the gas, um, but we're sort of in a bit of a flux in that respect, and it's less clear than ever, isn't it? Um,
Well, it comes down to your bias. So, is there going to be a recession or not?
right.
That's the big thing. When I say a recession or not, I mean this year. Okay.
Uh-huh.
So you have to make that determination fundamentally. Um, is it going to arrive in the fourth quarter or is it going to be next year? If you're in the camp that we are going to go into recession, then you're leaning towards dollar strength.
Uh-huh. Okay.
That's
And do you want to explain that sort of inconsistency to the members then? So, I mean, I've got a pretty good grasp on why the dollar would strengthen. I mean, have you heard the dollar milkshake theory?
So you mean like if it's bad, why would it get strong?
Yeah.
Yeah, it's really a global phenomenon is the big answer, but the short answer is think about it. What do Americans do when they're filthy, stinking rich? Well, they go out and they buy stuff. So if you go to a Walmart, first of all, everything in Walmart is not made in the United States. And if you're just, if you're going down the aisle and you see there's a 4K television for only $400. You're like, oh, I got money. I feel rich. I feel secure. I have a job. I think I'm going to have a job next year. I might even get a pay raise. So I feel comfortable in buying this TV. And you throw the TV into the shopping cart. Well, the thing is that TV came from South Korea. So what you're doing is you're giving up your US dollar and converting it into South Korean won. By buying the TV, you're selling the dollar.
Yeah. Right.
So when things are good and Americans are spending, because it's the largest economy in the world, because it's a reserve currency, it has some unique sort of attributes to it. So when Americans feel good, the dollar's weak. When Americans feel bad about the future, they're worried about losing their job, or they have already lost their job, or they're concerned about inflation, that inflation is killing their savings. So when they get too old to work, they won't have enough money to live. And all of a sudden they decide not to spend.
Yeah.
Then they're not, they're keeping the dollars domestically, and that keeps the dollar strong. And then add insult to injury, if the entire globe is slipping into recession and they're worried about their government collapsing, their economy collapsing, their banking system collapsing, then they prefer to keep their money in terms of the reserve currency. So they're like, instead of keeping it in their own economy, they decide to maybe buy U.S. treasuries. And so therefore they sell their local currency, they buy US dollars, and then they buy, let's say, the 10-year T-note. And now they're locked in the reserve currency, which is the least amount of foreign exchange risk for foreigners. So once again, that's in a bad scenario, they decide to buy the dollar. At the same time, the Americans are not selling their dollar. right? So
Yeah.
bad scenarios create dollar strength. Good scenarios create dollar weakness. So if you don't think we're going to go into recession, or the recession is going to be really shallow, the Goldilocks scenario, right? It's a shallow, mild recession, and there's not a lot to worry about, and therefore the dollar would weaken. So that's how you want to get to that conclusion. If and if you think it's going to be mild, you're generally selling the U.S. dollar.
Okay, great stuff. So on this chart over here, I've come from the monthly to the weekly, and I absolutely love these M and W formations. So I've highlighted an M formation.
Okay.
These tend to be reversion patterns across um, well, the fractal nature of the market. You'll see these turn up on the monthly, the weekly, the daily, all the way down. That they're less effective when you get into, say, the 15-minute chart because of the volatility, but they really work out very well on the longer term charts, all the way to a 4 hour.
Yeah, that's a basic role reversal pattern, is what I would call it. So you
Exactly.
have a lower low, so you're going to look for a lower high, and what you've highlighted there is price action. You could use Fibonacci, you could use a pivot point. They're all going to give you roughly the same idea. Sell a lower high. Agreed.
Okay. So we have this scenario here on the dollar on the weekly chart. We've got the reversion back in. So we have that displacement from the high volume area. We've had that displacement, and the market wants to rebalance, doesn't it? So it's come back up. And interestingly, it's come back up to that very critical structural point that was over here, right? That higher low that was the proponent to the last leg of that steep rally. And it's come back up to test that as a strong resistance area. So we're not only are we at a very pivotal point in terms of the Fed on the charts as well. So this is going to be really, really interesting going forward. If we can break technically back above 101, let's round it up to 50 as a round number, and that trend line resistance as well, and also last month's low. These dotted lines, the red dotted lines, that's last month's low and last month's high.
Sure.
So we're attacking internal structure, right, of the range. So the range is up here and all the way down to these lows. So we're attacking back into that internal structure, and it's either we come back down to the lows or we break that resistance, which could be a tough nut to crack, and then we're heading back up to last month's high. All right, so that's where we are on the technicals, on the weekly chart.
Now, when we look at seasonality, what typically happened over the last 5 years and what's typically happened over the last 20 years, between now and about the third week of August, US dollar is generally strong.
Okay. Okay. Fine. So now then, this boils down to the data, right? It all comes down to the data and whether it's going to underscore the belief that markets continue to underestimate the Fed's capacity to tighten. What's your outlook? I mean, we've got world interest rate forecasts looking at the odds for September. So we've got a long way, and even a day in markets is a long time, but we've got all the way until September, all of that data to come. Currently, they're pricing in about a 20% chance of a rate hike again. What's your outlook on that?
So I don't guess at these things. So one of the things I do is I have for every major central bank in the world their own economic projections all the way out to 2025. I can tell you factually, the Fed has already told us there's another rate hike coming.
Okay. Yeah.
So I have that projected out And so I take that as the truth. Now, a lot of people would roll their eyes and say, oh, well, you can't believe the Fed and you can't do this and you can't do that. But all I know is what I've been told.
Yeah.
And so I get that data directly from the Summary of Economic Projections, which is created by their own internal quant team. And that's what I have projected for the US dollar right now. One more rate hike. Probably not at the next meeting, the meeting after. So that looks like a November meeting. And
Okay.
in the September meeting, we will get a new update to that economic projection.
Okay. Okay. I just want to see in the chat if we've got any questions. Guys, those that are attending this, thank you for being here. Welcome. Excellent. Do you have any questions? I'm going to start monitoring the chat as we progress through these currency pairs. So in the meantime, before we move on then, what about the divergence theme that supports the US dollar? Are we converging between the central banks, or do you think with with yesterday's data compared to today's inflation, the dovishness that came out of the ECB, we can delve into the Bank of Japan. I know you like the yen and the Bank of Japan. What's your outlook on in terms of divergences or convergence?
Well, there are divergences, right? So one of the benefits of going through every central bank and seeing what their own projections are, they are diverging in their projections. They're not diverging in what they're doing now. They're diverging in what they're going to do next year. So, for example, the ECB hasn't given us any guidance. They don't tell us anything. So I have that as a flat line.
Okay.
They haven't told me anything. They haven't told you anything. So I don't know anything from that. But I can tell you, like New Zealand has projected massive cuts next year.
Right.
They're going to cut more next year than any other central bank by far.
And they were the first to lift off. Well, the first to take a very hawkish stance.
Yes.
Which is interesting, right? Yeah.
Yeah. And unless there's so the rumor now is that China's actually going to do something to stimulate their economy. That would be the one saving grace that makes their projections, let's say, need to be revised because they only know what they know. They can't have a central banking policy based on what China might do, right? So, like maybe China does come out and say we're going to spend $1 trillion worth of stimulus to turn the Chinese economy around. That might happen, but probably not. So if everything stayed the same, yeah, New Zealand it was the first to raise, were first to be very hawkish, and based on their own projections, they're going to cut a lot more than everybody else. So that'll be interesting next year. I might be heavily short that Kiwi dollar.
Right. Yeah. I mean, just looking at this weekly chart, we're in that downtrend still. It's tried to recover, and it's come up to a weekly resistance. So with that sort of projection, then in terms of the Reserve Bank, we've got last month's lows down here, just below 60, the figure. So we're actually jamming into this sort of coil. So a breakout is imminent looking. And I like to see these kind of these fake outs. So we've got that move up. Again, there's one of those W formations. We've moved up, we've moved back into the neckline of that. What I like to see in that sort of coil is a move out, a move back in, and then a move all the way back out, a move back in, and then it tends to move in the first direction. So in this case, up. But with that projection in terms of the RBNZ, and of course it depends on the Fed, that analysis could be incorrect, and we need to be breaking below 60 the figure.
So there's a timing issue, right? So what they're telling us is that the next meeting is going to be a pause. Next meeting after that is a pause. First quarter 2024 will be the first cut of interest rates in New Zealand.
Okay. Right.
And
So there's
then
plenty
followed
of
by
time.
cut. And
Okay.
significantly. So we're going to go from 6.11 is the average when you look at their average of the range of interest rates in New Zealand in the fourth quarter. It's just over 6%. And they're going to drop it all the way to 5.62. So I'm telling, it looks like a 0.5% cut in the January meeting in New Zealand. So I'd be
Okay.
ready for that ahead of time.
Okay. So in that respect, there are prospects of a move higher. We've got this sort of bullish flag. I also like to see these wicks. When you tend to see a wick like that and a small body coming toward, now we've got 3 days and 7 hours until the end of this month. So this month at the moment is setting up. In fact, this wick represents a pullback, right? So that represents shorts in the market. So what we could be looking for is a short squeeze into those shorts and then assessing the grounds from there. So there are prospects for next month for a bullish Kiwi. So we've got all of these shorts in the markets, all up here. The market doesn't let you stay in the money for long. So,
And that, by the way, is that Kiwi dollar? I can't quite see it.
yeah, that's the New Zealand dollar I'm looking at.
Okay, so let me look at, so right now, 56% of institutional investors are short the New Zealand dollar. And 66% along retail traders are long.
Okay.
So 56% of institutional traders are short, just the Kiwi dollar specifically.
Right. Okay. Well, on the weekly chart,
they're set short currently.
On the daily chart here, we've tested last week's lows. So we've got breakout traders, that higher time frame traders that were shorting that, and they've been squeezed back up. So we're going to have to wait and see how that turns up next week. Whether we're going to fill back into that wick and continue south, or we're going to leave all of those shorts trapped, and the market's going to run away very vigorously back into the coil and towards last month's highs, which are up at 42.50. So there's nothing really here jumping out at me on the chart to give me a bias either way. Personally, I wouldn't be trading the Kiwi dollar until I see either a move back in to those longs, and then the outlook is to continue lower.
Yeah,
Towards...
in fact, what I would do there, like kind of at the price we're at right this second, I would drop into a much smaller time frame and say, if it turns bearish, let's say on a 15-minute chart, drop it like it's hot. Because it's at a rule reversal. It's at what used to be support, so it'd be now resistance. It would be a lower high. If it fell here, it'd create the lower high on the higher time frame.
Right.
You know what I mean? So that's how I'd look at that. I move pretty quickly on the high time frames because I just want to know where the support and resistance is. I already know what my bias is.
Yeah.
You know, like for example, we went through and we very quickly said, well, you know, institutional investors are set short that Kiwi dollar pair. Cool. And it's been dropping. Great. And now we're at, you know, resistance. Great. I moved to a small time frame pretty quickly.
Well, what's interesting,
because that's tactical now. I break things up. Strategy is on a high time frame, and then once I believe I'm at a good price to execute my trade in the direction of my bias, then I move into a small one, and now it's tactical.
Right. Okay. So on this week, what we've seen is we've been pretty much coiled within a range, right? So we've had this range, and we broke out to the upside, and then we broke out to the downside. So we trapped traders up at last month's highs, breakout traders. We shorted into that. We came all the way down, pulling the market completely the other way, and lo and behold, we've come back up into those shorts. So we've got that sort of this impulse. Now, when we see this, So we've got this trapped market. We've come up, we've come down, we're moving back inside. So what we might find is we might continue higher, and then we've got all of that money that's been left on the table, all of that in the money short target on the upside. Or like you said, if we hold at these levels, so this is going to be an important level of resistance, then the bias is lower. Right?
So the way I frame it, it's like an if-then statement. If we go into that box that you just drew,
yeah,
then it rolls over.
Yeah.
Take a shot. Take a shot, drop a stop.
Gotcha. Great. I'm just going to look to see if we have any questions. Hi, Wayne. This one's for you. Can you see the chat there? Thanks for joining today. A question I had was as an intraday trader, how can I avoid confusing myself using fundamental data? For example, I can understand the long-term Fed projections, but daily data reports may vary, which can put me in two minds. I hear you. I can trade in the bias of the recent data reports, but this may contradict the long-term projection I have, which makes me hesitate at times. Good question.
So, yeah, this is where people confuse news with fundamentals.
Okay.
There's a difference. News creates volatility, and generally speaking, volatility is bad. Big institutional investors are concerned about volatility all the time. What we want to do is analyze trends in this economic data. Let's say non-farm payrolls, right? You don't, each individual non-farm payrolls isn't really that important. What you want to look at is the trend in non-farm payrolls, the trend in ISM services, the trend in PCE or CPI. Okay, but even then, what you're trying to discern is what is the policy that the Fed will enact because of these trends. The Fed or any central bank, they don't actually change their bias that much. They're either raising interest rates for long periods of time, or they've paused for long periods of time, or something's broken and they have to very quickly scramble and change a policy. What we're interested in fundamentally as macroeconomic traders is the current and potential change in monetary policy. So like one NFP, one CPI, they're not individually that important. What's important is, will the Fed change their opinion? So I look at it where the Fed has told me they're going to raise interest rates one more time. And so that is the policy. The next meeting, they're going to release a new summary of economic projections. And through the dot plot, they will once again tell us what their future monetary policy is likely to be. That sets my bias. My bias doesn't change very often. My bias fundamentally typically lasts years, not every news report or every quarter, every Fed meeting. So that's where the confusion often gets, where you're like, oh, well, CPI is improving. Is that good or is it bad? And then non-farm payrolls was less or more than expected. Is that good or is it bad? Well, it only matters if it changes the Fed policy. And for the last year and a half, nothing has changed the Fed policy.
Right, exactly. Yeah. So Wendy's saying, yes, me too. For example, FOMC seems like going to long-term bearish, but then yesterday data made the dollar goes up. And based on TA, seems like going to go higher. Yeah, so that's where you need that balance between the technicals and the fundamentals. Like Wayne's saying, the longer-term outlook will not necessarily be affected by the ebbs and flows per data, per day, per week. It's a cumulative over time that's probably going to sway the outlook.
It's amazing. My own research reinforces how important it is to do your own research. It's amazing. So Ross, you had mentioned earlier, like, oh, there's only a 20% chance of interest rates going up again at the next meeting. I know where you got that, right? You can do these calculations. And what's surprising to me is 20% say the Fed's going to raise one more time, and the Fed has already told us they plan on raising one more time. And so I look at it like it's a pretty good chance that the market is not positioned correctly. It's a pretty good chance. So when you look at what is it, 18 members of the FOMC, when you add the board of governors and all of them, you put them all together, and 16% of them say there's another rate hike coming. Like 16 out of 18. There's a pretty good chance they're going to raise one more time. I mean, again, that's just factual. I don't have an opinion. I just know what the people in charge are telling us. Some people say, some members of the FOMC say they're going to raise more than one more time. So for 80% of the market to say the Fed's done, I just don't know where they get that. That's an opinion. I don't do opinions.
Right.
So I have to be very, very, very factual. And when you like watch, financial media on TV and stuff, you get a lot of opinions, and it scares me because I honestly don't think they do the work. I really do, because I don't, right? Besides FX Street, the only place I get news information is directly from the source. I actually read every single report, and I don't know what everyone else's opinion is. I don't, because I only have the facts in front of me, and from that I formulate everything. And the longer I've been doing this, the more I've seen proven to me that that's necessary. It's
Right.
incredibly important.
Wait, just to interrupt the flow of analysis that we've got potentially on your dashboard. Can you see whether your music?
Oh, I have music. I have music on. Okay, hang on.
If you press that, if you look in the chat, I don't know if you can see the chat. Yohei's highlighted what the emblem looks like.
Oh, there's no music playing here. I clicked unmute it, and it started playing music.
So I don't know where the music's coming from, guys. We've got a question from trader Jerry. Where do you find the data on institutional trader position percentage?
The Commitment of Traders report released by the Commodity Futures Trading Commission every Friday at 4 p.m.
Right. Okay, great.
And from that, I can derive through process of elimination. So when you look at an exchange, the exchange knows exactly how many trades were made. Okay, so imagine Euro futures being traded or Yen futures being traded. So the CFTC gets this report from the exchange. How many contracts have been traded? How many are open? Okay. Now, then you look at large institutional investors. They're required to report their positions to the CFTC every Tuesday. They have to. It's required because they're so big that if something went wrong, the market could totally collapse. This goes back to World War II when the United States didn't know how much wheat was being planted by farmers or how much corn was being planted by farmers, and they needed to repatriate all that for the war effort, but nobody knew how much was planted. So all of a sudden, all this stuff was getting recorded by the government through the crop reports, and then they wanted to know the futures market, so then they started gathering that from the exchange. So anyways, these large institutional positions have to be reported to the CFTC. So you take the total positions and you subtract the institutional positions. And then there are hedgers in the market, bona fide hedgers. So if you make breakfast cereal, you buy wheat, for example, and then you hedge the position by, let's say selling futures. Now, you're not in the futures market to make money, you're there to reduce risk. So the government says, okay, you can do that. And in fact, if you report those positions to us, you won't have to pay any taxes. So there's an incentivization process for bona fide hedgers to report their large positions. And they are large positions. So now you have the total minus institutional speculators minus institutional hedgers, and then you have this number left over. What that is non-institutional speculators and hedgers. It's retail traders, small speculators. Okay, so when you look at this data, I can figure out where the hedge funds are, and I can figure out where the retail is. The idea is, you can contrast them, and I can very quickly tell you the position in the forex market where sort of where there's a divergence, if you will.
Okay, so for a retail trader, what information in that is the best place to look? Do you follow the hedge funds? Do you follow which?
Well, it's really, honestly, it's a bit of both, right? But the most important thing, like, there's a nickname for all this. There's smart money and then there's dumb money.
Yeah.
I don't like that at all. So I look at institutional positioning as much longer term positions. They're not in it for a couple of days. They're making big bets on the direction of the market based on, let's say, big data. They've done a lot of research and they decide they want to go long gold. Okay. Yeah. And they want to be long gold maybe for 6 months, maybe a year, maybe indefinitely. And then I look at retail, it's much shorter term, as we all are. We're generally not in trades for 6 months to a year like a big institution would. So that's how I look at it, as long term versus short term. So I think they're both important, but there are times when retail is just not on the clue train. They're trading the old trade that was working 3 weeks ago, and they're still selling high, right? They're selling higher highs for some reason. It doesn't make any sense, but they're still bearish when the market has actually changed positions. And so sometimes it's really important where the short-term traders just haven't caught up with the new sort of trend.
Okay. Now, I used to look at this data and then I just went straight to the charts, and I can't remember where to find the actual data. I mean, it comes through on Reuters anyway, so I want to access it there. It comes through on TradingView. I believe FX Street release it on our economic calendar as well. But I'm here on the website. Whereabouts on this website do we point our audience to find that data?
Right. So this is what I used to do 20 years ago. There's a little, I think it's on your right somewhere. Are you is that the CFTC?
Yeah.
Yeah, it is. Okay. Yeah, you download this giant Excel spreadsheet that is nothing but gobbledygook.
Right.
So it's almost irrelevant. So one of the services I run is quantbox.co.
Right.
And I gather all that data and present it beautifully.
Okay.
So I'm not making it as a plug,
Yeah.
but the honest answer is I've been doing this for 20 years and it used to be hard work. And now, so I automate that process.
Right, just give me a sec, then I'll put that up on the screen. Can everyone see that there? Yes, I'm on your website now, right?
Yeah. So that's it. So it sits on the Google Cloud. Am I able to share my chart? I'll just show it to you.
Yeah, sure. I guess you can.
I don't think you have permission though, or either that because you're broadcasting.
Stop streaming.
Yeah. Sorry, I have very little Discord experience. I'll catch up quick though.
Me too. Oh, I'm new to it. Well, I've used it for years, just on the other end of it, but actually the back end of it, no. So I wonder if I can give the stage over to you. Hey, if you're there, is there any way I can allow Wayne to take over? Okay, he's saying we'll get it all prepared for next week. But here's the website. Where would I point our audience.
Go to the bottom. Go to the bottom. There's a lot of pictures. There. Go up. Go up. That's it right there.
Yeah,
Uh,
yeah,
that's an older version of it, but that's what it looks like to me.
right. Okay,
Those are the
great.
positions. That's updated every Friday.
Well, that's
So
fantastic.
over the weekend, you should be doing this research and know where all the institutions are positioned.
Right. So just explain the non-commercial entities are are what? The retail market?
That's the large institutional investors that are not hedging.
Right.
Those are your hedge funds.
Okay. And then the hedge funds, where are they shown?
They're all hedge funds. That's all hedge funds right there. So long and short, long and short, long and short. Is it me? Is it him? somebody, somebody went out offline. Right on, Bloodwish. So did we
I
lose
had a
Ross
private.
or did we lose me? Oh, there you
Okay,
go.
you're back. Right. So I got a private message. Thank you, Bloodwish. Amazing and informative event. Absolutely. Yeah, Wayne is a great asset to us. Private message came through earlier, and I believe it was Sterling something or other. Let me check. So I just wanted. This came from. Can't pronounce that name. Logic 8. So cable. Let's look at cable. Cable. So let's have a look at Auntie Mabel. Cable. I'm going to go right the way to the weekly chart, and then we'll work our way in. Have you got anything fundamental we want to talk about in the meantime? We've got the Bank of England.
I looked at almost every aspect of the UK economy, and it's shocking how bad it is. It really is shocking.
Yeah,
Like import export data and stuff, like their levels of inflation, their levels of productivity. It's really, really unbelievable. Productivity has dropped to zero. Inflation is incredibly high, not just on its own, but relative to its peers. Um, it's a world of hurt fundamentally.
Okay. So where does that leave the Bank of England for next week? What are we looking at?
Well, they have high levels of inflation.
Yeah.
So they're going to want to have to deal with that, but they're between a rock and a hard place now. And when you listen to Bailey, he says it often. Well, he doesn't say it, but you can see it on his face. He's like, "We're damned if we do, and we damned if we don't." Right? Like they have to raise interest rates, which will make everything expensive, push them into recession. They're they're practically in recession already, and like it makes things worse. But they got to get inflation down. But it's really a conundrum. It's really a conundrum for them. But economically, it's dare I say a little bit ugly.
Yeah. Okay. So with lower growth prospects, though, doesn't that do the job of bringing down inflation anyway?
Well, sort of. I mean, yes, the if you stop spending your money, um, because you don't have any money, yes, then
Yeah.
the inflation cools off. Um, but is the economy better off? Are you better off because inflation came down because you lost your job and you lost your house and you sold your car to buy your kids food? Uh, you know, is that better?
Right.
Probably not. So they're really tricky now. They don't have a dual mandate like the Fed, so they can. I mean, but they're trying to get inflation down without doing too much damage. So I can tell you what they're projecting.
Yeah.
Um, interest rates are actually the way that they've been projecting to us. They're actually done raising now. I don't think that's true. That's just what they've projected to us. This is again their report, and that by the third quarter of 2024, everything will be right as rain, and they will be cutting those interest rates. I think having studied their economics situation, I think they're overly optimistic, and yes, they'll need to raise interest rates. Now, that is no longer factual. That's me now projecting against their projections. But I can pull up let me pull up their inflation forecasts. The UK was at 10.7, then 10.2, then dropped to 7.3. Okay, now we're at 6.3. Okay, things are improving. Now they believe, this is again, they being the Bank of England, we're going to go from 6.3 to 4.3 to 3.4 to 3.0 to 2.6. The Bank of England, in their own projections for inflation, say inflation is going to drop precipitously right now. Everything is golden. But I can't back that up when I look at the data. So I think they're overly optimistic, and I think they have a lot more work to do.
Okay, so we could be in anticipation of a 25 basis point rate hike.
Yeah. But again, in their own projections, they leave it the same. That's what they've told us.
On the chart, on the weekly charts, we've come right up into what is looking like, given that sell-off, a hefty area of supply. And we're still front side of that bullish trend, but it's vulnerable going into next week's meeting. So anything short of a 25 basis point hike could be very detrimental to the pound, that is teetering on the edge of a breakdown. And the key level in that respect, which is quite far out, and it's not something that would be likely achieved next week, but certainly building the basis for a break of below 126 the figure to attack 125.90 swing low. That will leave all those breakout traders up top trapped above those that month's high, which is over here at 128.50-ish. On the daily charts coming in, so looking into next week's business, then we would be looking at the following. We've got this downtrend to pull up, very strong movement to the downside as of yesterday's volatility. And we've got this tepid correction back up into those shorts, potentially fueling, making the food for a continuation to the downside. We might see some consolidation here, but let us see on the Fibos where we're at.
Have it like at 127.50 rising to maybe 130 for a sell. There's also a little bit of chance, I'd say a modest chance of a double top before it drops.
Right.
Okay. But really 130 is the sell, maybe 131. Right? That just changes the target. So I would say the most likely scenario is we might have already tested the 130 and we're on our way down to 124.03. So 124.
Yeah, I've got this on the daily chart. An unlikely scenario that we get back above 129 with any conviction.
If you found yourself, on Tuesday or something, and we're back at 130, it could be an interesting sell.
Yeah. I think anything above 129.50, which would take us up to the 78.6 of that bearish sell-off, I'd be definitely looking for my opportunity to get short.
I mean, even now is interesting. Like if you're looking at this on a 4-hour chart, this 128.87 is, and we're just tickling it now. We just touched it, an hour ago or something. That's actually a reasonable short and medium term sell. 128.87.
Okay, yeah, I would tend to agree with you on that. And also, You guys know I like my M's and W's, so we've got this reversion pattern on the 4-hour chart coming into a neckline. Yesterday's closing price would be the target for that short.
I would have it 125.18.
Okay, that's all the way down. That would be breaking major. You've got major structure at 125.90, which is down over here on the left. But the short-term play is a move back in. Now we've got an hour. We've got almost 2 hours. This is actually a strategy that I'm working on, and I'll just delve into it quickly. If this 4-hour candle closes bearish, which it's tinkering on the edge of doing, we've still got a couple of hours. I'd really love to see a close a little bit higher up to give us more room to short. But coming down in that respect to the 5-minute chart, you see we've got this. We're going to have this this trend line that we're breaking. We've already broken the structural higher low, which is up here. So we're breaking structure. We've come back up into the peak formation, which is up over here. And this is paving the way for a opportunity to short and target yesterday's close, giving you a 4-to-1, pretty much a 4-to-1 opportunity. But again, the strategy requires us waiting for the 4-hour candle to close bearish, and then we're attacking.
Where's your sell? Again, is it like right around 128.75, 80? Like
Exactly, 128 and the upper quarter of that handle, 128.75. At the moment,
I would take that down to 127.
Yeah, okay, great. So, I mean, what you can do is target that neckline, which tends to these tend to act as support areas, but indeed that by no means means that it can't continue. So you'd leave some on.
I did the same trade, just hold it an extra day.
Great. Okay, guys, so there's cable. Do we have any other questions coming through? How come Swiss going up against yen? Nice question. The Swiss and yen tend to trap one another as safe havens. Do you think the yen is still playing its role as a safe haven, Wayne?
Well, sort of. Like right now, all that matters is their yield curve control. Now they've changed their yield curve control. But the question about the Swissies specifically has to do with their outlook. So, like I said, I track all the future guidance from all the central banks. Switzerland is not going to cut interest rates next year.
Okay.
And everybody else is, except, well, the ECB hasn't given us any guidance, so I can't tell you what they say. They're not saying anything. But Switzerland will not cut interest rates, and other central banks will. So the Swissy is unusually hawkish, let's say, unusually strong compared to all the other currencies. That's why it's unusually strong. Typically, it's a risk-on, risk-off type asset, but it's not behaving that way. So again, that's really their forward guidance of, they're telling us, the Swiss National Bank is telling us there's no way they're going to cut interest rates next year. So it's not going to get weak.
So we can see that Swiss continue on up against the yen then?
Well, the yen is the variable. So let's say the Swiss franc is not the variable. Right. So right now, what will happen now that the yield curve control out of the Bank of Japan has been relaxed from 0.5 to 1.0? We don't actually know now. So we've been in this long period of years of just selling the Japanese yen. It was one of the most beautiful trends that we've had in like a generation that may have just ended. Don't know. We don't know. They're not aggressively raising interest rates from a central banking point of view, like the traditional sense. But in the untraditional sense, they're allowing the yield on bonds, right, in this case, government treasuries, which also influence how much corporations have to pay to borrow. They're allowing this interest rate, if you will, to double. Effectively just doubled interest rates. Is that significant? Not relative to everybody else, but it is a change in policy. I think what you found when this news came out yesterday and the day before, the yen got unbelievably strong really, really, really quickly. Okay? That's because, oh my God, this whole thing just changed and maybe the, yields go out of control. What we found is yield on the 10-year Japanese government bond went from 0.5 to 0.55. Actually, it wasn't a big deal. It didn't go to 1. The Bank of Japan just said they might allow it to go to 1. It just fizzled out. Actually, nothing really happened on the 10-year JGB. So everything that happened in the currency market with the yen yesterday is kind of given back today because ultimately people freaked out but the sky wasn't falling. It wasn't the end of the world.
We got a bigger move back in December, didn't we, when they tweaked? I think it was a 4% move in the yen back in December, which so what do you think about that report coming out from the Nikkei? I mean, we had the governor the previous week, telegraphing that there wouldn't be any near-term tweaks. And that happened too in the New York session. That came out. And then the Nikkei came out, obviously, with news drip-fed from their meeting. The conspiracy theories that come out, what do you think about that?
Uade said in his first press conference that he's analyzing and reviewing everything, which is the right thing to do when you take over an institution, that they were not doing it with any intent. Mm-hmm. He wasn't doing it to see if he should change yield curve control. So again, that's what he actually said. He didn't say he wasn't going to change yield curve control. He just said the reason he was studying things wasn't to change yield curve control. So now that he's done the study, now they want to let yield curve control change. Sometimes the media doesn't quite state it correctly. There was a Bank of England meeting about 6 months ago, maybe 9 months ago, where there was 0% chance of a Bank of England hike, and then the Bank of England hiked. At the press conference, they asked Bailey, they're like, "What the hell, man? You raised interest rates." And he's like, "I didn't say we weren't going to raise interest rates. You said we weren't going to raise interest rates." And, there's always this dichotomy, but Uade's got to run a central bank for a major currency. He needs to do what he needs to do. Right? So if he's going to change yield curve control, and maybe down the road that allows him to move interest rates from negative to not negative. Jack up interest rates all the way to 0. Maybe. But the Bank of Japan is a little different of a scenario because I've been trading for 20 years and they've essentially, almost certainly the whole time, have been trying to create inflation. Right? Trying to create it. And here we are now amidst COVID and post-COVID, and the entire world is drowning in inflation except for Japan and China. Mm-hmm. And Japan still hasn't been able to create inflation. Now, they have what they call qualitative and quantitative analysis of their inflation. There's good inflation and bad inflation. And so they're trying to create good inflation without creating bad inflation. And so I think what they're finding is there's some bad inflation creeping in, and there's some benefits, but there's enough room to maybe start adjusting. Maybe they don't need negative interest rates. Maybe they don't need to buy unlimited amounts of Japanese government bonds. You have to understand, there's no other central bank that is doing anything remotely as close to what the Bank of Japan is doing. They're buying every single Japanese government bond there is with unlimited amounts of money, and they own 70% of the stock market.
Yeah.
Let me do that again. They own 70% of the stock market. Well, I know the Fed can reduce their balance sheet by letting bonds mature. How do you unwind a portfolio of stock? You can't. I don't even know how the Bank of Japan gets out of this situation.
Right.
It's really, really, really incredible. And so now we got a new guy in there trying to figure out what to do, and it's very complex. If I had to guess, like a wild and crazy guess, someday yen is the first fiat currency to collapse.
Right.
Because I have a lot of education on this subject, not just 20 years of trading. I don't know how they get out of this. I don't.
Wow.
I don't know how they. Because listen, if they just sell their holdings in the Nikkei, and then Nikkei goes to zero.
Yeah.
Yohei says
Wow.
70% of the stock market. Wow, I wasn't aware it was that so massive. If I'm wrong, maybe it's 40 or 50, but it's an incredible. It's like saying Fed owns half of the S&P 500. Half of every share, 1 out of 2 shares is sitting at the Fed balance sheet. Like, it's so unbelievable that it really doesn't matter if it's 50 or 60 or 70%.
Yeah.
It doesn't matter, right? Like, it's unthinkable. But
Okay.
the problem is they can never sell it.
In terms of the yen versus the dollar, I've got this chart up, looking at the weekly chart. We're testing that critical structural level on the weekly chart at 138.43. We've had a third probe of it this week, and we're pushing back up, as you said there, Wayne. We're reversing much of what was done yesterday. Would you say that's teeing itself up for another pop back at that level at 138.43? We're on the backside of that bullish trend. We've come down. We're trying to move lower in dollar yen. Would you agree?
Yeah. Maybe. Yeah. So there's a couple of things.
Yeah.
For the yen, I would watch the Nikkei. So I watch the Japanese 225, the stock market. Also for the dollar, I'd watch the S&P 500. So in this case, I don't think the dollar moves the stock market. I think the stock market moves the dollar.
Okay.
That's how I look at it. Um, so right now, like I said, right at the beginning of this of our meeting, I said I'm looking at things short term, medium term, and long term, and it's a mixed bag. We're stuck. We're stuck right now. Maybe it's seasonality, like this is what happens during the summer, or maybe it's because the S&P 500 is topping out. There's a lot of evidence that could be happening, and we're ready for a bit of a pullback, not a collapse, but a fade, kind of stuff. Everything is ripe for a fade. And then I look at the yen. I'm like, this thing just collapsed over this change in yield curve control. And then everyone just realized they overreacted, and now it's coming all the way back. I'm like, so what's the rational trade here? I don't think there is one. I might have to wait till Monday or Tuesday for people to calm down.
Sure, absolutely.
So I need a few more pieces of data before I get all confident. But is it reasonable to think the U.S. dollar could strengthen? Well, typically in August it does. Remember our meeting we did, I don't know, 5 years ago, and I said, yeah, well, I'm short the Japanese yen now, but tomorrow I'm going to be long, and then it's going to fall for 3 weeks, and then there's going to be a false rally, and then all this kind of stuff. I'm kind of like thinking this, where if the dollar got strong in the next few days, yes, I will buy dollar. And I'll continue buying dollar until we get to about the 3rd week of August. Then I'll grow cautious, because typically what I do in this window between the 3rd week of August and the 3rd week of September is I start looking to sell dollar, sell yen. Doesn't mean I do it instantly. I start to frame how I look at the market. So if I'm looking at yen pairs and they double bottom at an obvious level of support, do I buy the double bottom?
Sure.
Because I think it's going to go up in that time period until the 12th of December.
Okay, so the outlook then for now is status quo. We're potentially building this sideways channel over the next, over the course of the next week.
Yeah.
We're between, say, the 61.8 Fibo, which is last week's high, and we've pierced last week's low, but we're sort of trapped. We're in a trapped environment. With a potential bias to the downside if this if we get any traction on this yield curve control bias that could strengthen the yen somewhat if that picks up in the markets. Okay, so going back to the questions, let's talk about the VIX. Can we use the VIX to check market sentiment? Is being asked.
I definitely do every day. So
Great.
let me pull up my risk gauge. So VIX right now for the day is down 5.57. It's flat for the week, and it's down 0.66 for the month. So that gives me sort of base. There was, I mean, a slight risk on today. Medium and long term, nothing, nothing. It's part of my analysis that I started with, where that was 1/6 of what I look at, and I say it's neither bullish nor bearish. So it's mixed. I got to be careful. I also look at the yield on the 10-year T-note. I look at Japanese yen futures. I look at the Dixie. I look at gold, and I look at the S&P 500. And it's on those 3 time frames, flat, flat, flat.
To say those again, those correlations, it was the VIX, the Dixie,
S&P 500,
and the
gold, dollar, yen, 10-year T-note, and VIX.
Great. Okay, so you're looking at those correlations, and you can apply those correlations, and that will give you an outlook for risk sentiment in the market, which you can then apply to currencies such as risk on, risk off currencies, like the Aussie, for instance. Would that be your?
That's exactly correct.
Okay. Excellent stuff.
No. You write it down. Bloodwish says, could you write that down? Anyways, I was just joking.
We can do. I can send you Bloodwish. Send me a message later on, and I'll get back to you on that information for you. Do we have any other questions coming through? I can't see how many people we've got. Oh, we've still got 26 people in the audience. That's a fantastic turnout. Really, really good. Guys, any other currencies you want us to look at? I don't know, Wayne, if you've got a life to get back to. We've been in here an hour and a half. Are you quite happy continuing? What's your?
Yeah, no, I'm golden. Everything's fine. I'm here to help. So
okay, and the show is recorded as well, so that's great. So we can, anyone that wants to go over this again can do. We're going to look into discuss market timing. Can you take the same trade? I'm missing the chat's moving before I can read it. Can you take the same trades that you would normally take at the end of the month at the beginning of the month? Well, at the beginning of the month, you've got the initial balance. So the first say week and a half would tend. Well, this is how I would look at it. The first week and a half of a month would set me up. If I was swing trading, would set me up, and you'd have that range, and you're either staying in that range, so you'd be in anticipation of an explosive move either way, or you would have come out of that range, and then you'll be gauging whether that breakout to the upside or downside is setting up a trend. And if so, towards the end of the month, I'd be looking to, if that trend is going up, I'd be looking to short into that length. So that's a very good question, because the initial balance of anything, whether a day, whether a week, sets you up for those trade setups later on in the week. What's your take on that, Wayne?
So I day trade into my swing trade, and I swing trade into my position trades, if that makes any sense. So I have trade plans for the month, I have trade plans for the week, and I have trade plans for the day, and they tend to all line up.
Excellent.
So the beginning of a market, so like Ross, you say you do a lot of your trading around the US market open. Love it. Perfectly agree with that. Coming in 3 hours late ain't gonna help.
No.
Most what I find is a lot of retail traders, they trade when they can because they still have a day job and all this other stuff. And they just sit down and like they throw down a trade on the euro dollar. That randomness is not going to work for you because you're random in a market that seems random. There's no way you're going to get consistent results doing that. So when you look at when the volume and volatility arrive, that's usually earlier in the morning. Let's say in New York time. Usually you should be sitting at your desk 7:30, 7:45, getting ready pre-news. And then after that, you have the stock market open. And then by 10 o'clock, yeah, like most of the bigger volume and volatility has already occurred. And then it sort of fades and fizzles out as you get into the London close. So the peak hours are that 7 to 10:30 period in New York time, right? But if you show up at 2 in the afternoon, you know, um, right, you're missing it. Now, the same thing is actually quite true. Like the beginning of the week and the beginning of the month are supremely important.
Yeah.
Supremely important. So
Absolutely.
yeah, you got to know what you're trading. So my monthly trades are almost always in the first couple of days of the month. I'll hold that for weeks.
Excellent. And the same can be true at the turn of a new year, right? New quarter. Yeah.
Yeah, like that meeting that we did when you were in front of a volcano and I was in front of a volcano, right? And it was like late December, and I'm like, look, it was like late December, and I said, I think I'm going to dump my whole position tomorrow because I believe the very first week of January the whole market's going to collapse. Am I thinking on an annual basis here? Yes, it wasn't just random that the first week of the year would create a downforce. It's like it's an important time to trade. So
Absolutely.
the beginning of the year, beginning of the month, beginning of the quarters can be important, but it's you're timing it around volume and volatility. So imagine you're surfing. You got to pick the right days when the wind is right and the current is or the tide is right, and you want to kind of time things, but there's a season for all of that. You can kind of figure it out. But you also then have to time each wave. There's no sense getting on the wave after it's just reaching you. You have to paddle in front of the wave a little bit, and then the wave carries you. And that's a bit of what we do. So if you paddle when the wave is hitting you, you will miss the wave.
Absolutely.
So you have to be at your charts at the right time, ready to go.
Yeah, timing is absolutely key.
And very often that wave analogy, that's when all the other traders are finally making their first trade of the day. So you kind of want to be there just kind of before that and figure out is it bullish or bearish today. Like for example, if you're at support, you can't sell it. Bears can't sell at support. It's impossible.
Yeah.
A bear can sell at resistance, but never at support. A bull could buy. So that would be in the beginning of the day, a bull could buy or not buy. Right? That kind of thing. So if you keep the rules of engagement really simple, you can, if you're a bull, you can only buy at support and ideally a higher low. Either buy double bottoms or you buy higher lows. That's it. There isn't anything else. And a bear can only sell double tops or lower highs. There is nothing else. So you need to find your levels of resistance or support and then line things up around these market opens, the weekly open, the monthly open. For example, I trade Sunday nights.
Okay.
The markets are opening. I watch Shanghai open Sunday nights. That's the beginning of my week.
Yeah.
London is closed right now, right to this second. My week's over.
Yeah.
London's closed.
Your trading is across various time frames. So you've got positions on for the year. You've got day trades going, swing trades going.
Scalp, spot, swing, trade, and carry.
Excellent stuff. You the man. That's great. We've got a question here about the Canadian dollar. What's happening with the CAD? I have no idea. Let's have a look. Well, like Wayne's saying, we're at support. See, I like to box things off. Everything I put into a box. So this is the box. We're at the low of last month's range. So the question is, are we working that low to come up? So that's the first thing I'm looking at. Are we working that low to come up? Now we've broken out of that consolidation that's been going since, well, topping out October 22. We've come down to break those lows. So there's another box that I'm going to draw. So I'm boxing that off. Okay, so the question is, do we need to come back up to continue with that narrative lower, or are we just about to burst lower? I would argue that we're working the low to come back up, and that piles into the longer term bullish US dollar narrative. Now we've got this trend line I can put on here, and we're still some way to go until we can come back up into there. We've got that M formation. So again, drawing my M formations. Okay, so we've already had a pop up, but we're just building. See, that for me is paving the way to entice people lower, come back up. Okay, so that's my outlook for the CAD on a weekly basis. I'm just going to remove that squiggle.
So you said up and then what?
So I think up and then, well, I don't know. I don't know from there on, but I think we're coming back up into the trend line. And so long as we stay front side of that trend line, that continues to fail, then that's building up. That's building the bearish case to come lower. So we need
coming down to 126.35.
Right. Well, there we go. So I think we need to come up first before we head lower.
As long as it's below 133.33, I think we'll be fine, and it'll drop to 126.35 in the medium term. And if that continues, then the actual target is 121.83.
Right. Okay. I think we're on the same page then. We're on the same page. So
that's the price action, right? So it needs to drop to 126.35. Then it'll probably go up and retest 130, and then it'll drop all the way down to 121.83. That's for the year.
Yeah.
Right.
Much nearer term, if we're looking for an opportunity nearer term on the daily,
Sure.
We're coming up into last week's highs. We're going to end the week high up within this box. Therefore, I'm looking for next week in the initial balance, Monday and Tuesday. If we hold those highs, then the low-hanging fruit trade is to the downside. And that might take a couple of days, maybe pulling breakout traders up into the 132.50s, stop hunts, whatever you want to call that. But there is liquidity being built on the downside to move into. So we've got liquidity on the upside. So we've got that M formations neckline, liquidity over here on the upside. So I think we're probing that, and then we'll just have to sit on our hands, wait and see how the week opens next week. But we're front side of that bullish trend so far. So this can continue up and up and up. But my bias, what I want to see is money being trapped up here, and then the explosive parabolic moves in the US sessions. So I want to see 3 levels of rise, Asia, London, consolidation up top into New York, and then to pile down maybe for a Wednesday midweek trade all the way into those longs that are being built. So that would be my thesis for starting next week on the CAD. And then from there on, we're pushing up and up and up into the trend line resistance. And then, as Wayne says, we're coming back lower in line with the dominant bearish trend over the course of time.
In fact, I would start to look to sell sell the USD CAD somewhere between the third week of August and third week of September. I don't know when, but I will be ready. So that's my job as a technician now. If we're up around, let's say 133, and it's August 21st, and I get a bearish signal, I'll sell it and I'll hold it for 3 months.
Fantastic.
Or I'll take a small loss.
Okie dokie. Right then, we have a question coming in. I believe it was on the euro. Can we discuss about the euro? I believe the euro being dovish yesterday, but I don't understand why euro quite bullish today. Right.
One way to describe it is 40%, according to the Bureau of International Settlements, 40% of all Forex trading, which is what, $7 trillion a day, 40% of it is euro dollar.
Yeah.
40%. So, and the big part of that currency pair, euro dollar, isn't the euro. Sorry if you're European. It might be the reserve currency. So it's funny, euro's become the anti-dollar. When I first started trading euro was becoming a new reserve currency. Then FX Street invited me to Spain to speak at a conference, and I got around a table filled with, I don't know, 6 or 7 other professional currency traders. And I gave my speech about how the euro was going to be the new dollar, and they're going to look at everything good about the US dollar, keep it, and then look at everything bad about the US dollar and fix it. And then it'll replace the US dollar. And all the European traders just started laughing at me. They're laughing at me. You're like, you don't understand anything about Europe, do you? And well, I was wrong and they were right. So anyway, so euro's no longer a reserve currency. So right now, if the dollar's strong, euro's going to be weak. If the dollar's weak, euro's going to be strong. And you might say, Wayne, that's grossly oversimplified. But you watch what happens. Like, for example, when the ECB is trying to strengthen the euro very often weakens, and vice versa. And no matter what they do, they can't impact their own currency. And it's because the US dollar just overpowers it. So you might want to look at that. You're like, why is euro so weak? Well, maybe it's because the dollar's strong. You want to isolate that. You want to do a relative strength exercise. Before you determine euro is strong or weak, you got to compare it versus everything. So I do that through a relative strength exercise, but I also create a euro index. So I'll just look at my euro index and I can tell you if it's strong or weak versus everything. So don't be too quick to judge if you look at euro dollar and make a determination on euro. No, it's probably dollar.
Okay, on the technicals, we are front side of that bullish trend. We came up yesterday right up into a 50% mean reversion of that sell-off that was taking place last week, right, from last week's highs. So we've come up into that area and we flooded the market with shorts right into that trendline support area where we are finding support once again. Now we're below last month's high, so we're trying to come down. We're trying to move lower, and it may take a little bit more upside according to these technicals. We've got a very strong correction from that trend line. It's come up to
this is a buy zone. If you were a bull, you'd be buying it, or should have already bought it, right? And now, if you're a bear, you need to get ready.
Yeah, exactly. Setting up for another attack of that trend line, and in that respect, we can come down to the origin of that leg, which is all the way down to the top of that box, 108.80. So I've got that as a target on the downside.
So I would argue, if I was a bear, I'd argue it's already on its way down.
Yeah, it is.
And that you sold roughly around where we are now. So
Yeah.
that's a 4-hour 21 and such like that. If you sold now, your target would be 107.
Okay, 107, and that is going down all the way to the bottom of that box,
It would
which
take
is
two
essentially,
weeks.
yeah,
Yeah, it'd take two
great.
weeks. What?
That's great. So what we've done there in that respect, we've taken traders up out of last month's range, only to pull right back into them, and we're heading back to pick up all of that money that's in the money longs below 108.35 down to where Wayne's talking about for an attack of 107. And while we're down there, why don't we just go for 106.50?
Or I actually have 106.03.
Okay, 106.03, which tallies up with March's rally, mid-March rally. All right, excellent. And how to trade emergency markets or emerging markets? So
I like emergency markets. So.
emergency markets is better. Dollar Mexican is too strong against dollar. So the Mexican peso is too strong against the dollar. It's making my tacos more expensive in this part of the world. So what do we think about the emerging markets? How do we go about the emerging markets?
First of all, one thing to look at, I mean, don't look at it as like, oh, it's an emerging market, it's peso. Look at it like, do some comparative analysis. If you look at the economic data out of Mexico and compare it to the majors, you're looking at inflation levels, GDP levels, productivity, other forms of productivity. Realize that Mexico didn't spend $10 trillion because COVID came out. Mexico didn't spend much of anything when COVID came out. So they don't have the levels of inflation that the major currencies have. So when you do that kind of economic analysis of that, they're in a better situation. The Mexican economy relative to like the UK is getting crushed. They have a terrible economy. Mexico has a great economy. So there's a lot of money going in there. Plus, like I do consulting work with hedge funds, and many of them are very interested. They've been plowing money into Mexico because they're also getting this positive carry. It's huge right now. Huge. What is it? 11%. I'll give you an example. Let me open my. I have an account. Let me open this one. Been short USD Mexican peso since February 13th at 5:46 a.m.
Since February, what year? This year.
This year, February 13th.
Okay, nice.
Yeah.
Very nice. Crikey. Okay.
Crikey, right? And I know a lot of others are very interested in the swap. So remember, I had to pony up $1,000 to buy a standard lot because you're leveraged, right? It just in swap, I've earned $1,858.18.
Wow.
Do you think hedge funds are on it because they're earning, that kind of swap? Yeah, it's a huge carry trade. Most of that time, the dollar was weak as well. But as as the participant pointed out, even when the dollar was strong, the peso was even stronger, and that is unusual. When you compare it quantitatively to the UK, to the United States, to Canada, so on and so forth, they're in a much different position and is quite favorable. And by the way, I spend time on the Central Bank of Mexico, Banco de Mexico. They have a fabulous website. Their team is fantastic. The research is top notch. Like they're legit. A lot of people would just roll their eyes like, oh, Mexico. Oh, dude, you should do some research. And they're doing really well. So congrats to Mexico.
So what was the motivation for selling in February? Because I mean that's extremely good timing. You're
Oh no, well, that had been going on. That there have been several trades going on. So like, I don't know, it wasn't the first. So it was just another kind of thing. Yeah.
Okay, great. Yeah, because I mean that took out February took out the
It was a lower high. So,
structure. Yeah, 17th of February.
so when it was at, I can't even remember the number now. When it was at 22 or something, I said it could one day go to 8.
Okay.
8. We're not there yet. But there's my thinking.
8. Wow. So
Yeah, like it's not even on the chart. Forget about it.
not on the
Right?
chart.
It's
Sure,
it's still
dinosaurs have come up at some point. There it is. So last time it was 8, it was all the way down 2000, September 2000, something like that. Okay, great. Well, why not? So,
I mean,
okay,
it's amazing if you do Google Earth and you fly over like Tijuana, which is a great place for Americans to go get drunk and get a leather jacket for cheap. If you fly over with Google Earth, oh my God, has a lot of infrastructure been built for goods and services crossing that border? You need to look at it differently. It's no longer just a vacation spot for Navy SEALs or something and college kids. Mexico's legit, and you see the amount of money going in there. And now the one part of this narrative of why you should own Mexican peso now has to do with COVID and nearshoring, where companies were scrambling. They're like, "Oh my God, our supply chain is falling apart. We can't get stuff out of China. Where are we going to get manufacturing and assembling done? And we got stuff stuck in Vietnam, and we got stuck. Where do we got to be closer to home? So where's the closest cheap labor you can get? The choice is Canada or Mexico.
right,
Mexico won that game.
absolutely.
And you're like, wow. So you got to take a new look at Mexico, everybody. And it's like a massive amount of money, I think, is going to go there over the next years, decades, right? Especially if you believe the nearshoring narrative.
Okay, and then in terms of the structure, and we're coming into what could be a demand area here. So you're holding on to that then, Wayne? Yeah. What do? You bring your stock down, or you just a run?
Yeah, the rest is just risk management. So, some of these spikes have been knocked out and then you re-enter, that kind of stuff.
Right.
But I pay a lot of attention to monthly pivot points on this one.
Right.
So there are times to freak out for sure on this trade. And let me zoom in on my chart. We are definitely in a weekly and monthly take profit zone for sure.
Yeah.
For sure. So I might want to move my stop down to 17.
Okay. Right.
But I'm trying to be brave. I'm trying to be strong. I'm trying to. So let me get a target. If I were to give you another target, hang on. Let me bring this up. The next target is 16.
Okay.
And that's important. That's an important level.
16 the figure, right on the nose.
16095.
Okay.
Oh.
All right. Good luck with that. So that's coming in around about just above. We've got a nice bit of space. Imbalance between 16
lower lows and lower highs, right? No need to freak out yet.
1570 just below that. All right, now we're going to start wrapping this up. I think this is heading into the 2-hour mark. I'm going to take one last question. Would you discuss what traders should look out for with expiring FX options and the London fix? Yeah,
I haven't seen option expiration, for example, being that big of a deal. Maybe it's just me. Maybe I'm missing it. Maybe I'm wrong. Maybe I'm naive. I spent a lot of time looking at like quadruple witching and triple witching. And I remember when I first learned about it a million years ago, I'm like, oh, that sounds so cool. It must be super important. And I just haven't really observed. Like it hasn't negatively or positively impacted me one way or the other. Um, so I don't know. All I can
Breaking up
tell
a bit there. Sorry, when you're breaking up, can you hear me?
here, I lose you.
I don't want to interrupt. Maybe everyone else can hear Wayne, but I can't. Can people?
Me. In sooth, I know not why. Get people here.
Okay, I can't hear Wayne. Yeah, there we go, Wayne. It could be the sign of the end.
Yeah.
If people can hear me, I think risk reversals are interesting. They can help with reading the market sentiment. So if anyone wants to look into that, I mean, look up risk reversals on the internet. They're quite a good guide. The London fixes, the Tokyo fix, they can give volatility at around that time. So I like to see some movement in the markets at those times. I'm going to have a call with Mike Peterson next. Well, I'm not sure when it will be. I'm speaking with him on Monday, just a personal call, and we're going to be with a view to having an interview with him, live platform such as this. Mike is a veteran. I don't know how many years he's been in the market. I take hazard a guess at some 40 odd years, being a youngster. I believe he headed up, was it the Bank of Australia, or it might have been UBS Forex desk. So he'll be the man to talk about Forex options and the expiry. I know he mentions that in his analysis. So presumably we can go deep on that with him there. And the topic of that discussion will be, is there an algorithm, a market maker algorithm out there to get us, or are we just really shit traders, keep getting stopped out at our own accord? So that's going to be an interesting topic, talking about smart money, market makers, how they participate in the market, the influence of algorithm trading that's come up over the years. So that's going to be one to watch. So I'll give you more information on that as that comes. So we've got a question here, but we're about to wrap up. Mike Patterson, I'll give you information on him soon. That question coming through. Is it enough to understand the sentiment of the market using VIX? How can we see clearly the sentiment of the market? Wayne discussed looking at yields, the yen, the Dixie, the S&P, and the VIX. A combination of those. There are correlations in there. I'll do an article on it. I might make I'll do a video for you on that, and I'll put it in the Discord channel. So we're making this public. This will go onto my YouTube channel, and Wayne will send you a link to this video. So if you want to do any promotion of your services, now is the time to do that. I'm just going to mention the FX Street premium service. So for those that are not part of that service, we've got this fantastic deal at the moment. There's so many benefits and features to the service. Check out our Trustpilot reviews. We're getting 5-star reviews and feedback. You're able to access experts such as Wayne, as myself, at a fraction of the price that you pay elsewhere. That is not an indication of how poor the service is. It's just an indication of our endeavor to give the market a fair price and to add benefit and value to this industry. So come along, join us, partake in these webinars, partake in our live market analysis, our signals as well that we're providing, and we're holding your hand throughout the way. This is suitable for beginners, intermediates, and experts. So a great community to be a part of. Wayne, is there anything you want to say about your services?
Yeah, do it. Can you even hear me?
I can in parts. Others can.
Yeah. Yeah. So, try QuantBox. That's all.
Quantbox.
Try quantbox.co. Oh, you got it up there. Yeah, just try it out. It's $8.
Right. Fantastic. Thank you all for being here. Have a great Friday and weekend, and we'll do this all again next week. I'll be doing a morning market scan, the watch list. As of next week, I'm starting earlier. I'll be here at 4 a.m. my time, no, 5 a.m. my time, 7 o'clock a.m. New York for the Open, giving you my outlook for the session ahead and what I'm looking up in terms of trade setups for the session. And I'll be doing a market wrap at the end of the day to see how those trades panned out and what we're looking ahead, what we're looking for the next trading day, and Asia and London for those setups as well. So on we roll, guys, with this. Thank you all for being here. Thank you, Wayne. And Wayne, we can have a chat if you want after this. You said you wanted to talk about something. If you're free, I'm free. Let me know. We can get engaged on Gmail chat. And yeah, thank you, guys. That was a good one. Have a good one, guys.
Cheers.